Annuities. Should you invest in them? Should you avoid them like the plague? Let's dig into it. Hello everybody, Joe Werbick coming at you, and today we are going to talk about the basics of annuities. We're not going to dig deep into different types of annuities. I'll record another video where we'll break down each and every type of annuity we're going to talk about today. Today's a good overview so you can maybe stop being afraid of annuities. I'm not saying that everybody should own an annuity. I'm not saying that you individually should or should not invest in an annuity. I just want you to have the information you need to make an informed decision. Now, the most important thing to remember when you're speaking of annuities is everything I talk about in this video is going to be based on the claims paying ability of the insurance company that issues the annuity. So you need to make sure that they have the ability to cover their debts, cover their losses, cover their payouts. So what you want to do is you want to look at their ratings. Now there's independent rating agencies. You have AM Best, Standard & Poor's, Moody's, Fitch's. You want to make sure that the company you're dealing with has a good rating from one of these companies, but that's no guarantee that the insurance company will be around forever. So understand that when I say it's fixed, or it's guaranteed, or it's going to pay an income, all of that goes back to the claims paying ability of that insurance company, and then each and every state may have their own benefits or guarantees to help those insurance companies. So just make sure you understand that. This is not FDIC insured. This is not going to be backed by the government. It's going to be backed by the insurance company that issues the annuity. So let's start with the two basic different types of annuities. We have immediate annuities, and we have deferred annuities, okay? An immediate annuity is an annuity that pays out an income to you for life. Let's say you're lucky enough to have a pension, and you've worked for a company for your entire life, and they've been putting money aside for you, and when you retire, they say, hey, great, you've retired, you work for us, we're going to pay you an income for the rest of your life. That is an immediate annuity. Basically, what happens is there's a lump sum of cash that goes to the insurance company, because annuities are issued by insurance companies. So this lump sum of money goes to the insurance company, and that insurance company guarantees you an income each and every single month for as long as you live. Now, you may have a survivor benefit. Maybe you chose not to take just for your life. Maybe you chose to take for your spouse's life. So once you pass, then that income would go on to your spouse. But you have to remember, with an immediate annuity, when you die, or if it's a joint, when both of you die, there's no money left, okay? So for the most part, on an immediate annuity, depending upon the payouts, and like I said, we'll take a deeper dive into immediate annuities in a separate video, but basically, it's, hey, here's an income for life, you can't outlive this income. That's a pretty powerful statement to know you're going to have income for life. So that's immediate annuities. Deferred annuities are basically deferring until you take an income stream. Now, just because you purchase a deferred annuity, it does not mean that you ever have to take an immediate annuity income stream off of it. So you do not have to. You're not forced all the time to turn your deferred annuity into an immediate annuity. And what we call that, when you take your deferred annuity and make it an immediate annuity, we call that annuitization. That means that the cash doesn't exist anymore. There's no lump sum. There's no money anymore. All you have is a payment stream. So immediate and deferred. Now, on the deferred side, you have two different ways your assets can grow while you're waiting to take an income stream. They can grow either based on a fixed account or a variable account. What I mean by that is, on the fixed account, that means you're not going to lose money. It doesn't matter what the markets do. It doesn't matter the performance of an individual stock or a mutual fund. On a fixed annuity, the value is never going to go down based on markets. It's going to go up based on a fixed rate. On the variable side, that means you're going to invest in some sort of an investment. And typically in a variable annuity, you don't have mutual funds. What you have are sub-accounts. They're like mutual funds, but they're held inside of a variable annuity, so they're considered sub-accounts. Now, on the variable annuity, there's things you have to consider. There's costs, Typically, they have mortality and expense charges, they have admin fees, they have death benefit fees, they may offer riders like a guaranteed income rider. Again, we'll break that down more when we talk more about variable annuities, but that's a variable annuity. The investments are going to grow during the deferral period on a variable basis, meaning sometimes the account's going to be up and sometimes the account's going to be down. Now, on the fixed side, there's two different options there. You have CD type and you have indexed. CD type, the reason I call it a CD type is basically what the insurance company says is we are going to guarantee an interest rate for a certain number of years. Let's say you get a 3-year fixed annuity that's paying 3%. What this means is you put the $100,000 in, at the end of the first year, you have $103,000. There's no fees, there's no expenses, nothing is taken out of your account, okay? You put $100,000 in, the end of the first year, it's worth $103,000. At the end of the second year, you now have $106,090. It's compounded, it's grown. And at the end of the third year, you have $109,272. Because again, it's compounding interest, it's growing. Traditional fixed CD type annuities have no costs, they have no fees, they state a return, you get that return. Now, they will limit your access to the account. Almost all annuities do not have full liquidity, meaning when you put the money in, you can't grab it all back out again. So some companies offer you a 10% liquidity feature or a 5% liquidity feature, or they allow you to pull out the interest. But during that time period that you own that annuity, you're going to be limited at the amount of money that you can pull out without a surrender charge. So that 3-year annuity, it grew for 3 years, it accumulated up to $109,000 and change, and at the end of those 3 years, you have complete access to the money, you can pull it out and move it. Now, I'm not going to get into how this money is taxed. Again, we'll share that with a later video, but know that at the end of the contract, the money is yours. It's not forced to be annuitized. You don't have to turn it into an income stream. You can simply take that money and walk away. That's a CD type annuity. On the other side, we have indexed annuities. So that is a fixed annuity, but instead of growing at a stated interest rate, it is going to grow based on an indice. Now, each and every insurance company is going to offer different indices. They may offer the S&P 500, the Dow Jones. You may be able to get a fidelity index or a volatility index. I mean, the indices, there's a ton of them out there to choose from, but know that it's fixed. And because it's fixed, it will not lose value based on market losses. So if you put $100,000 over here and the markets fall apart at the end of the first year, you will still have $100,000 unless you have fees. And it's very important you understand that. The variable annuities typically have fees. The fixed index annuities may or may not have fees. Your traditional CD type fixed annuities typically do not have fees. And every single insurance company is going to offer a different type of annuity with a different structure. I just want you to understand the basics so you're not afraid of annuities. Annuities can be an integral part of your financial planning. I never want you to put all of your money into annuities. It's a bad idea, just like I don't want people to put all of their money into the stock market necessarily. You should diversify your assets. Talk to a qualified advisor. Talk to a CFP, a certified financial planner, and allow them to show you how fixed indexed or CD type fixed or variable annuities may play an integral role in your financial planning. I'm not going to recommend this to anybody because I don't know your situation, but don't be scared of these just because your friends or your stockbroker told you annuities are bad. That's like saying the Gremlin, which was a bad car back in the 70s because it blew up if you rear-ended it, the Gremlin was bad. That doesn't mean you should never buy a car. That means you probably didn't want to buy that car. Understand there's different types of annuities. So, as I said at the beginning, immediate, deferred. On the deferred side, we have fixed and variable. And on the fixed side, we have CD type and we have indexed annuities. Now, as I said, I'm going to create videos on each of those. We're going to do one on immediate annuities, one on variable annuities, another one on CD type, and one on indexed annuities. We'll go more in depth so you have a better understanding of what annuities are. But you need to understand this because there was a tax law that was just passed, and annuities will now be allowed inside your 401ks. So I want you to understand what you're getting into and is it the right investment for you? As always, I hope you enjoyed this video. If you liked it, please hit like. If you'd like more videos, make sure you subscribe, and I will talk to you next time.